I'm Gregg Gerken. I work with TD Bank in the Commercial Real Estate Group, and I head up the U.S. real estate platform, which covers most of the United States on the institutional level and from Maine to Florida on the regional and commercial development side. In 2018, the trends that we are following and what we're hearing from most of our investors fall into three major categories. One is taking a look at where we are in the real estate cycle, considering this has been a very long and protracted recovery. Number two is, given where pricing, cap rates, and interest rates have been, which are historically low and have been very advantageous to investment, you have to be concerned about where are we going. And I would say, lastly, there are some pretty interesting trends happening with respect to property usage, both in multifamily, and especially in the retail space, and the trend is shifting more and more away from brick and mortar. And then lastly, I'd take a look at the office use and the age of a lot of the office stock, and a move towards more efficient co-working spaces, and just a complete rethinking of what is considered to be efficient and in many ways green space that is very important to millennials and frankly a lot of corporations that are becoming a lot more better global citizens in some ways. We get a lot of information from our investors, and we spend a fair amount of time, listening to our clients, and in analyzing any deal, have to be the absorbers of a lot of information that they're willing to share, and in turn have to believe in the story. So I would say that for the most part, what we are seeing through the investor's lens is they are searching for that next best opportunity, because there are just fewer of them. The reasons we watch jobs as a leading indicator is jobs really are the best indicator of what demand will be. Without a job, look what happened in 2008. You can't afford to live. The consolidation of households happened. Office demand decreased. Consumer spending decreased. So one of the trends that we look at is the general health of the economy, but primarily what is happening in jobs. I mentioned before, we're at a really good equilibrium. We've had a slow and steady recovery. The job market has been extremely strong, probably as good as it gets. You could consider it to be full unemployment from the number of people employed. But the other thing, if you look at some of the trends in the quality of the jobs, there seems to be a big gap between the best jobs out there and the white-collar positions and those that were traditionally filled by a lot of blue collars, but by a lot of blue-collar employees. And the concerns that we have is when you look at the overall trends, will all of those converge and create continued demand for real estate as we know it today? Office use today is different than what it had been. Office stock is aging. A lot of our infrastructure has aged. So it is hard to really see beyond 2018, other than to say we know it will be different. We are watching these trends carefully. It will impact, but I kind of look back to the core to success in any real estate investment is owning the right real estate in the right place with the right plan. And if you have those elements lined up, I think you'll be fine. The concerns, of course, are when you get into secondary or tertiary markets, or you happen to be in a market where the towns, the cities are in some way decaying and dying because there just aren't new jobs being created. That creates its own problems, and we're seeing the ripple effects of what happened in the late 70s and 80s with manufacturing moving overseas. And will those trends reverse? And if they were to reverse, will they reverse in the same way that we traditionally expect a manufacturing job to be filled, or will it be replaced by robots and AI? And I was at a conference a couple of weeks ago where you take a look at what the future. Who would have thought self-driving cars and delivery trucks would be on the road already today? those trends are going to continue, and all of them are going to have an impact on the usage of real estate, the amount of infrastructure and the type of infrastructure that the country needs going forward. And regulatory front, we're starting to see some shifts and changes in stance by the government in terms of eliminating some of the regulation, which is typical of the pendulum swinging from one extreme to the other. We ended up in an economic crisis that rippled around the world because our regulatory rules and people's willingness or ability to follow them in a way that was in the best interest of the health of the overall economy clearly didn't work. Did Dodd-Frank take it too far? Maybe, and arguably, but we've also avoided, a second downturn, and the recovery is now going on its 10th year. So in some ways, one could argue that although the growth has been slow, it's been steady, and there's been a certain amount of equilibrium. The concern I would have, and I would think that is going to be played out, is whether this imbalance in some of the impacts of these regulatory changes and/or tax changes throw off that equilibrium in some way. If you start with household formations, subtract the amount of for-sale housing that's being built, what's left over, needs to be filled by the multifamily housing, and the number of units that have been built in total, multifamily plus for residential for sale, has not equaled the number of households being formed every year. And I think probably the unseen number in that, which we have no way of measuring, is how many kids still live with their parents, or how many families moved together back in 2008, 2009, again by necessity, that at some point in time would love to be able to afford a home of their own. And then I look at one other report that we've seen recently, and that's from the Harvard study on housing, and they would portend that there is a looming affordable housing crisis coming, because most of what gets built is either Class A or close to Class A, simply because given the cost of land, given the demand, you really can't afford to build anything but Class A housing in the for-market space, or the market space. If you look at the affordable space, one of the concerns we have, and again trends going forward, is what happens with this pending tax bill, which could have an impact on the value of tax credits, which oftentimes bridge the cost gap between what it costs to build an affordable housing unit, versus what can somebody afford to pay in rent. And that gap was always covered by tax credits. If the tax rate drops, the value of that tax credit is going to go down, which means the amount of money that's available to affordable housing developers is going to be squeezed somewhat by less value in that tax credit. So those would be the major trends that or I should say we are looking at, simply because many of them, the story has not been told yet, but it certainly is going to be interesting to watch.